Here's the calculation almost everyone runs when they picture retiring with the house paid off. Rent nearby is about $1,500 a month, which is $18,000 a year, and generating $18,000 a year from a portfolio at a safe withdrawal rate would take roughly $450,000. So a paid-off house feels like $450,000 of savings you never had to accumulate. That number is wrong, and it's wrong by a lot. The honest figure is closer to $64,000. But here's the strange part, and it's the reason this video exists. The real value of a paid-off home is much larger than $164,000. It's just that almost none of it comes from the thing everyone counts. And the part that matters most doesn't show up until the worst possible year of your retirement. Let me start with why the $450,000 figure is fiction, because it comes down to a concept I want you to hold on to for the whole video. Call it the standing bill. Your mortgage is a bill that arrives every month until the day you kill it. That's the one everyone thinks about. But underneath your mortgage, there's a second bill, and that one never goes away no matter how many payments you make. Property taxes on a typical single-family home now average $4,427 a year nationally, up more than 3% in the last year alone. Homeowners insurance averages around $3,000 and has risen roughly 46% since 2021, about 3 times general inflation. Maintenance runs 1 to 2% of the home's value annually, which on a $400,000 house is at least $4,000. That's about $11,400 a year, or $952 a month, on a house you own free and clear. Paying off your mortgage stops the first bill. The standing bill keeps standing. So the honest comparison against $1,500 of rent isn't a savings of $1,500 a month. It's about $548 a month, which at a safe withdrawal rate is worth roughly $164,000 of portfolio, not $450,000. Anyone who plans around the gross number is building a retirement budget that's off by about $11,000 a year. A paid-off house doesn't pay you, it stops charging you. I'm Mike, a regular guy who reached financial freedom on an ordinary income. This channel is where I explain the money stuff nobody ever sat us down and explained, the way I'd explain it to a friend across the kitchen table. If that's your thing, hit subscribe. The first-year math badly understates the real value, and it does so in 2 different directions. The first is time. Rent rises, and it rises on the whole payment. Your standing bill rises too, since taxes, insurance, and repairs all inflate. But you've permanently deleted the largest component of what a renter pays, which is the part covering the landlord's mortgage and profit. So, you're only exposed to inflation on the smaller remaining piece. Run both forward at 3% a year. In year 10, the renter is at about $2,016 a month, while the owner's standing bill is about $1,280, a gap of $736. 10 years after that, the gap widens to $989. By year 30, the renter pays about $3,641 a month against the owner's $2,211, a difference of $1,330 every single month. Across a 30-year retirement, that widening gap is worth far more than the $164,000 the first-year snapshot suggested. The second direction is the one almost nobody quantifies, and it's the reason I'd argue a paid-off home is worth more than any spreadsheet says. It changes what happens to you in a bad market. Picture the same household 2 ways. Both spend $60,000 a year before housing. Both collect 2 average Social Security checks totaling about $49,700, and both are 66. The only difference is what they did with $200,000. Version A kept the mortgage and invested the money. They have $800,000 invested and a $1,400 monthly payment, so their annual spending is $76,800. Subtract Social Security and their portfolio has to produce about $27,100 a year, which is a 3.4% withdrawal rate. Version B used that $200,000 to pay off the house. They have $600,000 invested, no payment, and spend $60,000. Subtract Social Security and their portfolio needs to produce about $10,300 a year, which is a 1.7% withdrawal rate. Look at what happened. Version B has a portfolio that's $200,000 smaller and a withdrawal rate that's half as large. On a net worth statement, A looks richer. In the only measurement that determines whether you run out of money, B is in dramatically better shape. Now drop a bad market on both of them in year 1 down 22%, followed by a partial recovery of 8%. He ends the second year around $618,000. B ends around $484,000. A still has more money, which is what the spreadsheet will tell you, and it's true. But here's the difference the spreadsheet can't show. Version A's $27,100 withdrawal contains $16,800 that is a contractual obligation. The market fell 22% and the lender does not care. That money leaves whether the timing is good or catastrophic. Version B's entire $10,300 is ordinary living expenses, and every dollar of it is adjustable. If B wants to skip a trip and trim 10%, their withdrawal drops to about $4,300, and their portfolio is left almost entirely alone to recover. That's the whole thing. Selling investments at the bottom of a market to make a payment does permanent damage, because those shares are gone and they don't participate in the recovery. Version A might have to do that. Version B never has to do anything, and the first few years of retirement are precisely when that difference decides outcomes. Because a portfolio drained during a downturn often never catches up even after the market fully recovers. The interest rate on the mortgage was never the real risk. The payment was. A paid-off house doesn't pay you, it stops charging you. Now, let me be equally honest about the case for keeping the mortgage, because I'm not going to pretend this is one-sided. If you locked in a rate around 2.5 or 3%, the arithmetic genuinely favors keeping it. Paying off a mortgage is a guaranteed return equal to your rate, and a guaranteed 3% is worse than what a diversified portfolio has historically delivered. Over a long horizon, keeping that mortgage and investing the difference usually wins on paper. And the research supports that. At 6 or 7%, the case flips completely because a guaranteed 7% with zero risk is genuinely hard to beat. So the rate matters. What I'd add is that the rate answers a different question than the one a person nearing retirement is actually asking. At 35, a mortgage payment is a minor constraint on a rising income. At 63, in the second year of a bear market, that same payment is a forced sale in slow motion. The math doesn't change with age. The consequences of being wrong do, which brings me to the trap that can wreck this decision. And it's the one that gets people who've decided correctly and then execute badly. If the money to pay off your mortgage would come out of a traditional 401k or IRA, stop and run the tax before you do anything. Every dollar you withdraw from those accounts is ordinary income in the year you take it. Pulling $200,000 in 1 year doesn't just get taxed at your normal rate. It stacks on top of your other income and pushes you up through several brackets at once. And the damage doesn't stop at the tax bill. That spike in income can make substantially more of your Social Security taxable in that year. It can trigger a Medicare surcharge 2 years later. Since those surcharges use a 2-year look-back and land as cliffs where $1 over a threshold cost you the full tier. And if you're under 65 buying health insurance through the marketplace, it can push you over the subsidy cliff and cost you the entire premium credit for the year, which for a couple in their early 60s can be $20,000 by itself. Put roughly, if you need $200,000 net to clear a mortgage, and the combined effects lands you near a 28% effective rate, you'd have to withdraw close to $278,000 to get there. You just paid nearly $78,000 in tax to eliminate $200,000 of low-rate debt. That's not a payoff, it's a penalty. The workable versions look different. Paid off from a taxable brokerage account or savings, where only the gains are taxed. Spread the withdrawal across several years to stay inside a low bracket, chipping at the balance instead of clearing it at once. Or simply direct new money at the principal during your last working years so it's gone by your retirement date without a single. Large withdrawal. The goal is a mortgage-free retirement, not a mortgage-free Tuesday. Now, the side of this nobody puts in a video titled The Value of a Paid-Off Home, which is that the asset owns you back a little. The standing bill is the obvious part, and it's getting worse in a way that's genuinely new. Insurance has stopped behaving like a predictable expense. 71% of homeowners report their costs have risen, with 42% saying they've gone up a lot. The national average runs near $3,000, but that hides enormous spread, with low-risk states around $1,500 and high-risk states like Florida averaging well over $8,000, and analysts project further increases of roughly 8% in both 2026 and 2027. In some regions, the problem isn't price at all. It's that insurers have withdrawn entirely and homeowners get pushed into estate plan of last resort at a much higher cost for less coverage. The less obvious part is that a house anchors you. A paid-off home buys freedom from a payment and costs you flexibility of movement. If you want to spend the year near your daughter in another state, or 6 months somewhere warm, or try a place before committing to it, the house is still sitting there generating its standing bill and needing someone to watch it. Renting it out sounds simple and isn't, especially at 70 and especially from a distance. A renter can leave at the end of a lease. An owner has to run a sale, and sales take months and cost 6 to 10% of the price in commissions, repairs, and moving. There's a tax wrinkle on that sale worth knowing if you've owned a long time. You can exclude up to $250,000 of gain when selling your primary residence, or $500,000 if married. Those limits were set in 1997 and have never been adjusted for inflation, not once, while national home prices have risen roughly 94% since. A couple who bought in the 90s in an appreciating area can now have a gain that exceeds the exclusion, with the excess taxable. One thing that helps is the documented improvements over the years: a roof, an addition, a remodel. Add to your cost basis and reduce the taxable gain. Receipts from 20 years ago can be worth thousands. And there's the mistake that this whole framing pushes people into, which is counting the house as savings. People say they have $1 million, meaning $400,000 invested, and a $600,000 house. Those aren't the same kind of money. Your investments produce income. Your house produces shelter and a standing bill. On a net worth statement, they look identical. In your monthly cash flow, they're opposites. And that's precisely why so many older Americans are technically wealthy and practically squeezed, with taxes and premiums climbing against an income that doesn't, which raises the question of how you'd ever get at that equity without moving, and there are really only two answers. A home equity loan or line of credit lets you borrow against the house, and the obvious problem is that it recreates the exact monthly payment you spent 30 years eliminating on a fixed income, which is the fragility we just spent this whole video avoiding. The other is a reverse mortgage, which people treat as either a scam or a miracle, and is neither. The honest version is that it converts equity into cash without a monthly payment, with the loan coming due when you sell, move out, or die. It fits one specific situation well, which is someone who is house rich, cash poor, and firmly intends to stay in that home for life. The costs are substantial, the fees are real, and the equity your heirs would have inherited gets consumed. Federal rules require an independent counseling session before you can get one, and that's a feature rather than an obstacle. It's a tool for a narrow problem, not a general strategy, and anyone pitching it as free money is skipping the parts that matter. Related to that, and more likely to come up than most people plan for, is what happens if you need long-term care. Medicare doesn't cover it. Skilled nursing runs around $9,700 a month in 2026, and for many families, the home ends up being the funding source of last resort. Two things are worth knowing in advance. If one spouse enters care while the other stays in the home, the house is generally protected while that spouse lives there. And if you eventually rely on Medicaid, states are required to seek recovery from your estate afterward, and the house is typically what they look to. That isn't a reason to panic. It's a reason to decide out loud whether the house is your legacy or your care fund, because it can't be both. Let me also name the part that isn't financial, because pretending otherwise would be dishonest. Staying in a home you've lived in for decades has real value that never appears in a spreadsheet. It's near your doctors, your friends, the neighbors who notice if your mail piles up. Housing stability and social connection matter enormously to how people actually experience these years. And a retiree who optimizes the math by moving somewhere cheaper and ends up isolated has not obviously improved their life. If the numbers work either way, stay. When they only work by moving, know what you're trading and choose deliberately rather than by default. So here's how the house actually fits into a retirement plan. It doesn't get added to your savings. It shows up as a smaller monthly number, which produces a smaller target. Take your expected monthly spending, including the standing bill, subtract your Social Security, and multiply the gap by 300. That's your real portfolio target, and the house helped by shrinking it rather than by growing anything. That framing also settles the comparison people always want, which is whether the equity would have done better invested. Over long periods, a diversified stock portfolio has generally outgrown home prices. So on pure appreciation, the market usually wins. But that misses what the house is doing. Your investments have to grow enough to pay for housing forever, while the house deleted most of that obligation permanently. One is an asset raising an expense, the other removed the expense. That's why a paid-off home can be the right choice even when it's the slower-growing asset, and it's also why counting it twice, as both a growing asset and a reduced expense, produces a plan that doesn't work. If you're still working with a mortgage, the target date matters more than the payoff speed. Aim to have it gone by the time you stop working rather than as fast as humanly possible, and not at the cost of your employer match or your emergency fund, which are both higher value uses of the same dollar. The reason the retirement date is the deadline is everything I showed you with version A and version B. A payment during your working years is an inconvenience. The same payment during the first bad market of your retirement is what does permanent damage, and one caution people miss. Don't drain your liquid savings to pay off the mortgage. Someone with a paid-off house and $8,000 in the bank is in a worse position than someone with a small mortgage and $80,000 in the bank, because the first one has to borrow at high rates the moment anything goes wrong, and a house can't help. In retirement, liquidity is often worth more than being debt-free. Here's your one job after this video. Find your standing bill. Pull your last property tax bill, your current insurance premium, add 1% of your home's value for maintenance, and divide by 12. Most people have genuinely never calculated it, and it typically lands between $800 and $1,500 a month depending on the home and the state. That number belongs in your retirement budget as a real line item, not as a zero because the mortgage is gone. Then ask the second question, which is whether any part of your spending is a contractual obligation you couldn't reduce in a bad year, because that's the number that actually determines how safe your retirement is. A paid-off house doesn't pay you, it stops charging you. And the whole point is that what it stops charging you is the one bill you could never negotiate with. If this was useful, hit subscribe. This is what I do every week, plain English, nothing to sell you. Next video, uncovering the decision that moves more retirement income than any housing decision you'll make, which is exactly when to claim Social Security, 62, 67, or 70. The break-even math that most people get backwards, and the specific situations where claiming early genuinely is the right answer. I'll walk you through how to decide for your own life. I'm Mike. I'll see you in the next one.